The key macroeconomic risks that were present in 2015 have continued to drive investor sentiment in 2016, namely China's slowdown, negative interest rates in Europe and now in Japan, falling commodity prices, mixed economic data out of the US, and also high valuations. What we've seen earlier this month has been extremely oversold markets, and since this we've seen quite a sharp rebound, primarily in commodity and energy sectors. Whether this is merely a short covering rally that fades in the next couple of weeks or months, or whether it can turn into something a lot more sustainable on the upside, remains to be seen. But what we do know is that volatility will remain elevated over the coming months, and we only need to look at the chart of the Australian equity market over the last 8 months to confirm this. So what causes this volatility? The Australian share market is the second most concentrated in the developed world, with the top 10 stocks accounting for more than 50% of the market, and growth or cyclical stocks representing 80% of the total market. With this type of composition, investors must be prepared to accept a higher level of volatility and also extended periods of out and underperformance relative to other global share markets. And this chart highlights the roller coaster that most Australian investors have been on. This takes us to the next chart, which shows that the Australian equity market has traded sideways for the last 10 years. After peaking at 6,851 points in November 2007 and bottoming at 3,120 points in March 2009, investors have not been rewarded with any capital gains in the Australian market. Whilst high dividends have been paid, this has been at the expense of long-term capital growth. With China slowing down and the commodity boom over, the Australian market may find it difficult to deliver sustainable growth in the short to medium term. Investing in the broad Australian equity index requires you to buy good, bad and indifferent companies. It can set investors up for quite average returns over the long term, and it requires the markets to always rise in order to make money. Within the Australian equity market universe, there are other strategies that don't rely on the markets to always rise to generate returns. We're referring to equity market neutral strategies, which invest both long and short to profit from rising and falling stock prices. What we're effectively trying to do is remove the equity market direction risk and focus more on relative value strategies and dispersions or spreads between individual stocks. And this strategy, or these strategies, have performed very well over an extended period of time. This chart shows the returns and risk from a composite of 6 Australian equity market neutral funds over the last 3 years and 9 months ending December 2015, and it compares this to the Australian equity market. The equity market neutral composite outperformed the index by almost 2% per annum over this period, which was a very strong period for equity markets, and it did this with significantly less volatility or risk. Effectively, the Australian market had 4 times the amount of risk compared to the market neutral composite and generated less returns. This chart shows the drawdowns or losses of the market neutral composite in purple versus the drawdowns of the Australian equity market index in black. It can be seen that over the last almost 4 years, the worst monthly return for market neutral was 0.5% negative versus negative 12.7% for the index, which also took 7 months to recover. These market neutral strategies are available for investors who do not want to be constrained by a benchmark or an index and who want downside protection. However, investors need to move away from the traditional approach to constructing their portfolios in order to achieve this objective. In a low growth and low interest rate environment, returns are going to be harder to come by, and we could be faced with this dynamic for many years to come. Traditional investments such as government bonds, long-only equities, and strategies linked to benchmarks aren't conducive to the current market environment. We've seen this with the Australian equity market, which has now tracked sideways for 10 years, Whilst investors have received dividends, there's been zero growth. Active management rewards investors. There's significant divergences in markets, and those divergences enable active managers to generate returns from sources that typical long-only investors don't have access to. Why constrain your opportunity set? By being able to invest both long and short really broadens the investment opportunities that investors can achieve, and also provides strong downside protection in falling markets. If you'd like to discuss your investment portfolio and your options in more detail, please contact your Morrows advisor. We can tailor a solution that suits your objectives and that suits the current environment.